Money, Money, Money Insurance Special, co-presented by Exide Life Insurance.
Welcome. You're watching Money, Money, Money. I'm Samira Abdi. You just saw those visuals of the Financial Advisor Awards, which we held just a short while back in Mumbai, where we've honored the best and the brightest financial advisors from across the country. And some of them, actually two of them, are here with me in the studio this week. So let me introduce them. We have Anubhav Srivastava, who's the head of Passive Asset Management at Motilal Oswal Asset Management, the AMC, which won the award for the best performing wealth distributor. And also with me, we have Pratit Bobe, General Manager for Retail Liability Products at ICICI Bank, who represents the team which was awarded the best performing private bank. And also with us is Mr. R. Raja, Executive Vice President and Head of Products at UTI, our old partner for the Financial Advisor Awards, helping CNBC TV 18 further the cause of financial inclusion. Gentlemen, thanks very much for joining in. And this week, I actually want to focus on the exchange-traded funds. So this is something that we actually don't speak about very much. That's the ETFs. But despite being cheaper and more transparent, ETFs are often perceived to be the country cousins to mutual funds. So what exactly is an ETF? What does it do? And why does it deserve a place in your portfolio? So that's exactly what we're about to find out this week. All right, so let's get started. Anubhav, let me first start with you, because you've actually tracked ETFs very closely. So how well are ETFs actually doing? I mean, just to get some trends about whether they've actually picked up pace over the last few years, what's the kind of proportion that ETFs sell to about the money that mutual funds manage to get?
Actually, the difference is huge right now. We've got barely 7,500 crores in ETFs. Which is excluding the gold ETFs, which are actually fairly large. Overall, we're talking about $1 billion or that equivalent, which is lying in equity and related ETFs in the country, which is a very, very small fraction of, let's say, the total amount of money that's there out in equity funds as a whole. One of the trends that I have seen personally in my association with ETFs is that the number of investors has probably gone down significantly. As you have an NFO for an ETF, you typically have a large number of investors, and that tends to decline over a period of time. And the reasons for that could be many. Experience with the ETF, could be somebody's targets are being achieved, so they are getting out of it and maybe getting into something else.
All right. So Anubhav has answered the facts. Pratit, I'm going to put you in this spot and actually get you to give the reasons actually why this hasn't worked out. I mean, besides being listed, they aren't very much different from mutual funds, right? Or at least an index fund for that matter. Why is it that they're not finding the kind of appreciation that I would imagine an ETF would find, or even in Western countries, the kind of attractiveness that ETFs hold for even institutional investors is not there in India?
All right, so first let's put things in perspective with respect to if you were to sort of break the pie between mutual funds, index funds and ETFs. I think the large differentiator comes from the point of view that your mutual funds are actively managed and index funds, by the very definition, are index hugging. So the return which an individual will get will pretty much mirror the return which a index would give, as against what you see on actively managed funds. Then comes the point of ETFs, which are slightly different from index funds, because index funds still get managed, get floated as NFOs and then get managed, whereas ETFs are particularly listed on stock exchanges, and which involve an additional step for an investor. He needs to start by opening a demat account. And I think one of the reasons why customers in India have preferred investing in mutual funds is the difference that they have witnessed over the last many years between actively managed funds and index funds. And if you see maybe the last 10-year data, you will find the difference is on an average 4 to 5%, which is quite large if you look at it over such a large period of time. So the cause of ETFs, I guess, while they are very convenient from a customer point of view to invest in, the cost structure might be friendly because you buy an ETF, pay the broking fee at that point of time and sort of just sit. It's very, very efficient, but it's still a very, very small market like Anubhav just alluded to. And I think there's going to be a lot of effort required by the industry as a whole, the AMCs along with distributors, if you really want to propagate it and make it commonplace. I think the operational challenges of opening demat accounts aren't really as large a challenge, but it's really, I think, the awareness which needs to be created with customers about this being an active investment option, which yet needs to be resolved.
Fair enough, because even demat penetration has been on the up and up.
It has improved.
Okay, so let's pose that question to Mr. Raja. He says a lot of interest and a lot of push is required from AMCs and distributors. Are you looking at fresher ETF products? What's the way now to make it more attractive? Because I know a lot of people have told me that distributors don't push it enough because it's not very economical for them to do so. So is there any way that it can be made more attractive?
See, when we compare with abroad or overseas market, there's a couple of differences which exist between what is here and what is abroad. The one thing is the presence of a aggregator, institutional aggregator, who aggregates the small funds, the individual funds, and invest in ETFs is very much there. Whereas if that type of institutions are not very much there, now EPFO is there, but we have to have more superannuation funds and other similar aggregators. And also the another one is the fee-based platform, where the advisory platform, which also gives advice, because ETFs don't pay commission. Right. So naturally the present distribution channel which sells mutual funds in India is perhaps not suitable for ETFs.
But Anubhav, let me come back to you. For 11 years nearly now that the ETFs have been around, you said the facts, right? So you know it, that it's just not picked up. Is it just that the passive nature of these products is not appealing? I think everyone over here agrees that actively managed funds, the returns have been so much better. Is it just that, or is it something else besides just the fact that it's not economical for distributors, which is dragging ETFs lower?
I think the answers are already here from the 2 points of views that we just heard. One is that there needs to be a lot more that's to be done in terms of promoting the product itself. Now, for example, let's talk about returns. If you were to talk about Indian market returns, that's one thing. But if you were to, let's say, start introducing other currencies, where you have ETFs denominated in US dollars or euros or Japanese yen or something else, and you inherently have a nice benefit that's built in for the investor. So one problem is that you don't actually have a large number of ETFs. And the other thing, as was just pointed out, is that structurally, globally, the market maker, the person that actually manages all the liquidity in the ETFs, that makes sure that everything is available at the right price, it does not have a differential tax treatment in India. So the moment you go from an ETF that is created, right, by somebody who's doing it in bulk, which is then sold to retail investors or even institutional investors in the market, and then it comes back to the ETF, on the different leg, and it is redeemed, you actually have a lot of cost that is built into it. That cost, if it gets passed on, then the low cost argument will go out of the window. So efficiency in terms of the market mechanics is important. The other bit is there just needs to be more of them.
Yeah, and that's true actually. You've actually hit the nail on the head. Is that there just aren't enough, right? So there's a gold ETF, and then there are the ones that track the index, right? So why, Pratit, would I not buy just an index fund? I know you said earlier, about the math of it all, but if a client was to come to say your bank, would you recommend an ETF over a mutual fund or an index fund any day?
I think it's got more to do with what the investor is looking at. right? And if an investor were looking at a fill it, shut it, forget it strategy, then maybe that's the right thing for investors. I think our experience is that investors often are looking at beating the benchmark, because they all believe we are wise investors ourselves, and what's the big deal about, you know, buying a stock and getting a return which is equal to what the index gives me. And the common request is for getting something which sort of gives you an alpha. And if that's the expectation, then you know, buying an ETF may not meet with that requirement. However, the reality of the situation is actually that if you just look at our own returns of the index, ever since the index was sort of incepted, if you look at the BSE returns, the index over the last 32 odd years has done almost 100 times, right? And it would have been a great strategy to sort of buy it, shut it, forget it. But you know, the investor psyche is such that you constantly think that you want a return better than the index, and which is what sort of propels them in the direction of actively managed funds. That's the only reason in our mind why you find actively managed funds has become a category which is so large.
A few years back, I don't think anyone even knew what actively managed funds meant.
That's
I mean,
right.
it's only in the last 2-3 years that this term itself has become so common. But Mr. Raja, finally, you know, because you have your pulse on distributors across the country, what's the kind of feedback that you have gotten after you sieve through all the ones about commission? What else is left behind from what the dealers are telling you?
The dealers, perhaps, as already pointed out, they want a alpha. But the one thing which the index funds provide for an investor, index or ETF, is perhaps the expectation and the realization there is no differentiation. In an index, in an actively managed fund, you may hope to get an alpha, you may end up getting negative returns also, less than the market. But whereas in the index fund, you are sure of what you are going to get. I think index fund is very ideal product. Both ETFs as well as index fund are quite ideal product for one's asset allocation and at a very low cost. I think it will grow because there is very much requirement, and with the positive traction because of EPFO investing, the trust in the product will also improve, and that will be that will provide impetus to the investors also investing in this fund.
Yeah, that's true actually, and you raised a very good point about the EPFO. So what we're going to do now is take a very quick break. When we come back, we're of course going to continue talking about ETFs, but despite the step-brotherly treatment so far, our AMC is now looking at a lot more ETFs because of the EPFO interest in it. We'll discuss all of that in a bit. Stay tuned for more.
Money, Money, Money Insurance Special, co-presented by Exide Life Insurance.